Hi, this is the RiskWire webcast, where we break down what's happening in the housing market. And I'm Reena Agarwal, Senior Research Economist at Veros Real Estate Solutions.
My name is Eric Fox. I'm Chief Economist at Veros Real Estate Solutions. So I think today we've touched on this topic in previous webcasts, and we're going to dive in a little bit deeper today. And that is, when we look at the market, it seems to be stuck. When we look at the housing market right now, it seems just to be stuck. When we look at the number of sales compared to pre-pandemic, they're about 1 million sales per year below what we saw in 2019. Interest rates, they've by and large been creeping down. But there's a lot of people that want to buy a house, but they just aren't yet going into the market. So everything seems to be pointing that rates are lower, people should be buying homes, the rate of home purchasing is way below. So what's really going on today with the housing market, Reena?
So let's first set the stage with what is happening in the housing market with respect to what are the key fundamentals. So we all know that there has been significant underbuilding over the past few decades in the US, which means that there is a shortage of several million homes. Also, what is happening right now is that the listings of homes is much less than what it was in the pre-pandemic era. And when I'm saying less, that means that's an average for the US. But if you drill down to regional markets, in some markets, listings can be really sparse, like we see in places like Connecticut. Or in some markets, listings can be really high, even higher than the pre-pandemic market. So overall, listings are low. But another factor that is playing into this whole listings numbers is that home sellers who are putting their homes on the market, they can either choose to cut on the prices they expect because they all are expecting some prices which their neighbors sold their homes for or which their friends sold their homes for. So if they do not get that asking price, they may choose to reduce the asking price, or many are choosing to even delist their homes. So here we have a supply shortfall. And mortgage rates are also playing an important part in the housing market today. Rates, like you said, have declined from 7% to under 6.2%. So rates have declined by more than 80 basis points. They are at the lowest level in a whole year. But again, they are not low enough to bring back homeowners to the market for them to break out of that supply lock-in that we've been seeing over the past few years.
One thing I wanted to mention is affordability. And I think one of the things, or one of the big blocks to allowing some of the market fundamentals that would normally stimulate housing demand, as you said, with reduction of interest rates, that would naturally bring people into the market. But if we backtrack a little bit and look at what happened over the past 5 years prior to the pandemic in 2020 until today, in most places in the United States, house prices have gone up dramatically. In many markets, they've gone up 20, 50, 100%. And so they aren't just a little bit higher, 10% higher, 15% higher. So a reduction in interest rates suddenly makes a given house affordable. It's just unbelievably expensive. And when we combine that with that same 5-year period, and we look at things like inflation, higher food costs compared to 2020, we're getting into scenarios where families are saying, that's great, interest rates are coming down a little bit, but I still don't have enough to make that down payment. I still don't make enough to afford that monthly housing payment. So affordability really is a problem today. And a lot of times, the standard economic 101, you reduce interest rates, demand will go up. That affordability is not allowing that to happen.
So talking about affordability, the Mortgage Bankers Association really put out a number recently. And according to them, the median mortgage payment that a family makes, that has actually gone up from September of last year to September of this year by a little over 1%. So it's not that mortgage rates have gone down, so affordability has improved. Like you said, it has not. So mortgage payments are actually creeping up. And what is really happening with mortgage rates going lower is that homeowners are choosing to refinance rather than buy new homes. So they're making their current homes more affordable rather than taking on new debt in this kind of uncertain market. So they're choosing stability over risk right now.
And I think when we look at the dynamics in the government all around us, we know we've got a government shutdown going on right now. That's impacting some people perhaps more than others, but it's creating uncertainty. And one thing people don't like is uncertainty when they're making one of the largest financial decisions of their entire lives, and that is to purchase a home for the first time. Or even somebody who owns a home to sell that home and buy another home. For example, with the shutdown, we know that unemployment is creeping up. It's 4.3%, but that's as of August. And we haven't had an unemployment report since then. So there's a lot of uncertainty. And so I think a lot of people maybe who even could afford to do the down payment, they could afford the payment with the interest rates. That's pulling back a little bit on demand from those types of folks as well, who are going to say, let's wait until we get a little bit more clarity, make sure everything resolves itself so we can enter the market with confidence. And I think there's a little bit of that going on right now.
Yeah, so talking about the labor market, where that uncertainty is stemming from, so some of the numbers we are seeing, they're not majorly encouraging. I was recently reading this report by an outplacement firm. They're called Challenger, Gray, and Christmas. According to their data, for the first 9 months of 2025, the hiring total was around 205,000. And we haven't seen such low numbers since 2009, when the US economy was coming out of the Great Recession. And also compare that with the fact that employers have cut 950,000 jobs during the same period. And we see these kind of low-level numbers only during recessions or when the economy is undergoing major shifts. And think back to 2005, 2006, when the early waves of automation were leading to firing or layoffs of manufacturing and tech jobs. So even though the US economy is growing, according to FOMC projections, that is the Federal Open Market Committee projections, the US economy is expected to grow by 1.3 to 2% in 2025. But what we are seeing is a hiring slowdown. We are seeing that employers are pulling back. Many are laying off workers. And this is highlighted by the fact that the Consumer Confidence Survey, which the conference board recently put out, this shows that more Americans are now expecting that there will be fewer jobs over the next 6 months. So what this means is that workers are feeling uncertain about their job situation, and this uncertainty is trickling down into the housing market. So basically, like you said, when people feel uncertain about their job situation, they delay major life decisions such as purchasing a home. And businesses are also tightening up because a lot of them are absorbing these high tariff costs in favor rather than increasing their payroll numbers. So we are seeing that in some cases, automation is taking over a lot of jobs. For instance, Amazon recently laid off several thousand workers in favor of AI-driven automation. So the labor market situation is turning weak, and which is bringing in uncertainty into the housing market.
So that's all true, Rena, everything you just said. And then I read last week in the Wall Street Journal, there was an article, and it said, despite all of the negative news we're hearing that you just cited,
Yeah.
they're saying, yet all of that, it's not really causing the economy to tank.
Yep.
Everything's still going forward. And so that seems a little unusual, because normally when you start getting these early signs, companies start cutting hiring, then that then translates to recessionary type things, house prices going down, and we're not seeing that. So what is going on? And so the article talks about a lot of different things, but one of the things that could potentially be going on right now is we've got a secondary dynamic going on that we've never had with previous house price declines, say back in 2007, 2008. And that is the retiring of the baby boomers. So perhaps one of the things we are seeing is the softening labor market being by and large absorbed by the retiring baby boomers, so that the company is allowing the retiring baby boomers to take out the slack out of their businesses, so they can continue to downsize a bit without impacting the jobs of the actively employed folks, and unemployment rates aren't skyrocketing as a result. So time will tell whether that continues to be the case, but there's certainly some offsetting effects due to the pretty dramatic increase in the baby boomer retirement that's going to be going on between now and about the year 2030.
Yep, I agree with you that baby boomers retiring are certainly, kind of blunting this impact of these large layoffs that are happening. And also what is happening right now is that the Fed is trying to steer the economy into a soft landing. It's a balancing act for them. The Fed just cut interest rates for a second time in October, but they have cautioned that another rate cut in December is not a guarantee. So what I think is that for the housing market, we do not know where the mortgage rates are going to be. I mean, for the Fed, it's like inflation remains persistent, but the housing market is weakening. So there are all these factors that are playing into the housing market. So that is why there is a lot of uncertainty in the market. And where do we go from here? Like you said, what can we expect? Perhaps folks have to wait it out, see where it's going, because largely right now the fundamentals are unchanged. There is a demand backlog, and that demand backlog will convert into purchases only when folks can afford to buy homes. But at the same time, supply is low, house prices are high. So I guess mortgage rates have to decline further for folks to be able to afford the homes. What do you think? 5% is a magic number that will break open the housing market for folks to put their homes on the market and others to buy the house?
That's based on our analysis from earlier in the year. That's what we've said. The rates would need to go down below 5% in order to unthaw the housing market, just due to the interest rate variable. Unfortunately, we don't see that happening.
Yes.
We certainly see interest rates staying in the high 5, low 6 range, but certainly we don't see them getting below 5%, at least with the current fundamentals that we have in place. So unfortunately, I hate to say, I think the sluggish sales that we are observing now are likely to continue. I think the modest price increases, it seems strange to say, but the modest price increases, and by modest I mean 1%, 2%, 3% nationwide. There will be pockets where we have increasing and pockets where we have decreasing markets, but overall, sluggishly increasing prices, that's probably going to continue. And as a buyer, that's a challenge, I know. And the best advice that I can give, and I always give this advice, is that if you're in it for the long haul, this is just noise along the way. And if you fast forward 30 years, all of this discussion is probably going to seem silly because you're going to be sitting on an asset that's worth 2 or 3 times more than what you paid for it today. So if you need a house, if you're starting a family, if you have the financial fundamentals to do that, even with all this uncertainty, I recommend going ahead and doing that. But certainly understand that it's a difficult time to be a buyer.
Yeah, so it's really a waiting game for many in the housing market. Let's hope that the housing market starts bouncing back soon and more people can afford their dream house.
Well, that's a good note to end on. Thank you, Rena, for your insights. Thank you for joining us on RiskWire.
Thank you.